cuestiones que le vamos a plantear a continuación a nuestro invitado, porque ya tenemos con nosotros a Timothy Fiore, es presidente del Comité de la Encuesta de Empresas de Fabricación del ISM. Timothy, thank you so much for having us a new year in Negocios television. Thank you so much. It's a pleasure and Happy New Year.
Happy New Year too. Thanks for having me.
Timothy, new data we've known today. Economic activity in the manufacturing sector in the US contracted in December for the second consecutive month at 48.4. What does it mean for the sector and the overall US economy?
So a couple of things here. I've been saying for the last couple of months to your listeners and watchers that we're probably sitting in a period here of 48 to 52 PMI performance, and we came in at the lower end of that 48. We didn't break the floor, but we still came in at the lower end, and predominantly that was due to a continued decline in new order rates. So let's talk about what that means. There's 18 manufacturing industries that make up the manufacturing industry sector, and in the month of December, we had 80% of those in contraction mode. 80%, that's a big number, but that could be a 49, it could be a 48.5, it could be a 42. So what I've been doing lately now is I'm looking at how many are contracting, what percent of the industries are contracting at 45 or less. And in the month of December, we had 31% contracting at 45 or less, up from 13% in November and 7% in October. So clearly the weakening is continuing. Our demand softening number, which I track pretty religiously, 31% of the comments that came in November or December indicated that they're still seeing a lack of new orders coming in. Many of these are probably because we're at extended lead times. That number is up from 22. So, the story I think of December is we finished the year. We had a good year. There was a big breath, a sigh of relief that was taken. I think people kind of marshaled their energy here then for 2023. December is a pretty heavy month where our seasonal factors have a big factor in. And I think in this particular case, a lot of people took vacations, a lot of people took the second half of December off in the United States. And as a result, we saw production come down and maybe buyers not re-entering the market. But, part of the other stories here are price increases as well as the employment number. Although we did expand on employment, which was a bit of a surprise, we're still recording for every 3 companies that are commenting about employment, 2 are hiring and 1 is not. Remember, that's been going on now for about 4 months. And that compares to, for every 10 companies back in the summertime reporting, 9 were hiring and 1 was not. So we still have that hire-fire ratio at a very close levels, which is a little bit concerning. In the month of December, we had fewer comments around layoffs. I think that has something to do with the holiday seasonality issue. I would expect that number to probably pick up in January, February, especially given that our backlog is falling. Our customers have plenty of our inventory just right, and lead times are still not coming down, and people are going to have to take steps on the labor side. Mm-hmm. So, we did a review on the forecast several weeks ago, and the business panelists predicted that for 2023, by the time we get to the end of the year, it's going to look a lot like 2022 from an outlook standpoint. But they also said that half one of 2023, the first half, is going to be more difficult than the second half. And you can even argue that you're going to see the first half be stagnant, and all the growth for 2023 will occur in the second half. We also predicted that we're going to see a 5.5% growth in revenue for 2023 compared to 2022. That's a strong number if you're comparing that to a recession or a real slowdown. That's a really strong revenue growth number.
Mm-hmm. Well, as you said, in December we have some seasonal factors that impact in this data. And as you say in the report, Timothy, this is the lowest level since the coronavirus pandemic recovery began. What can we expect now from next month?
So, January is not a very strong manufacturing month either. It's usually a recoup month. I think this year, today in January, we did a lot of the recouping in December. And it doesn't mean that we won't have that recovery period in January too. There's a lot of cleanup that occurs. There's a lot of, restructure, line movements that happen at the end of the year, and it crosses over into the first part of the year. But, I think we're going to have some difficulty here. I mean, with 31% of manufacturing declining at 45 or less, that's a little bit alarming. I mean, I'm hoping that number is not going to get much worse. We have chemical products, which is a big part of that. I mean, I know they're under 45, and that's 14% of manufacturing GDP. So that's almost half of it. So, and we have others that are getting close. So I think it's going to be a struggle for the first half with all the headwinds that we're faced. It's a very strong U.S. currency. Europe demand still sluggish. China's starting to open up, but I think they're going to have trouble with consumption due to illness and absenteeism and things. So it's I'm still really waiting for lead times to come down. We haven't seen the lead times come down to the extent that we thought we would. We're still 35% above trough lead times. If we gave half of that up, I think that would be really good for buyers to re-enter the market. We've got prices declining now for several months. We had 88% of our respondents say that they were paying the same or less month to month compared to the prior month. And in October, that number was 67%. So prices continue to get weaker. I think buyers are waiting for them to get even weaker before they reload their order streams. They're waiting for lead times to come down because that's the right match. Shorter lead time, lower prices, place the order, move on. And I think we're kind of waiting for that. So I'm really anxious now. I'm looking for February because February is a pretty good manufacturing month. You start to really get geared up for the summer seasonality around the world.
Timothy, fears of recession in the U.S. continue this 2023, although many expect it to be shallow and short-lived. There is room, considering this ISM data, that can we see it as a clear sign of an upcoming recession in the U.S.? How do you see it?
Right. So we're an early indicator of the economy. We're less than 20% of the total economy, but we're an early indicator, and we're highly cyclical. So we are not cycling much. I mean, we're moving a half a point. That's been going on for 7 or 8 months. We were at 57 or something like that in the summertime. We came down 1.5 points, stuck there for 2 months, came down another 1.5 points. So we're not really cycling. And then you combine that with the forecast that we reported on several weeks ago with you, and it says that 2023 is not going to be so bad, but the first half of 2023 is going to be a little bit harder than the second half of 2022. So I think our panelists pretty much said, look, based on what we see, what we know, we're a little bit concerned about lack of backlog, but we think we're going to ride through this thing, and by the time we get to the end of 2023, it's going to be a fairly decent performance year compared to 2022. No worse, possibly slightly better. So that's kind of where we're at on it all. I mean, I think one of the interesting things here too is on the prices side. I don't know if I mentioned this to your watchers yet, but we're 88% of our respondents are reporting the same or lower prices compared to November, and that was 87% in November, up from 67% in October. So prices are still moving in the right direction. I think the fact that we didn't see energy markets get all upside down in December because of the steps that were taken in Europe is a pretty important piece. So hopefully energy markets will stay fairly stable. So one of the early indicators that will indicate that, hey, demand is coming back, suppliers are stressed, is the transportation sector. So in the transportation sector, it's been pretty weak. I'm getting very few comments about problems, disruptions. There are some, a lot of comments around ocean freight coming down. Road freight has been coming down for quite some time. The spot to contract rates are getting tighter. So that's probably the first indicator that things are going to really start to zoom up a bit, is when transportation gets a little bit stressed. And my guess is that we won't see that until March, April. But it's really interesting here with the Lunar New Year starting in 3 weeks, I think it is. We didn't see a huge problem at the U.S. ports in December. And you're not seeing it in the media right now about a huge problem. And normally, before the Lunar New Year, there's a whole bunch of inbound container ships because, they pretty much shut down for 4 weeks. You can't get anything shipped out of there. So it's an interesting, entering 2023. I've been doing this now for going into my 6th year, and there's never been this level of uncertainty about what all the signals are saying. Now, during the pandemic period, we had to respond to illnesses and shutdowns and government mandates and more money getting thrown into the system. This is one where demand and supply they're not in equilibrium, but supply is no longer restraining demand. So the question now is, okay, where's the demand? And you have all this headline information about higher interest rates, slowdowns, People are a little bit cautious. I thought the survey that the business panel put together was pretty good. I mean, it said we're not going into a recession. We're going to grow 5.4% revenue for the year. Profitability will be pretty good. We're going to continue to invest in capital equipment. And by the time we get to the end of the year, it's not going to be that much different from 2022. That's a pretty good message.
Mm-hmm. Pretty good message. And as you say, we have a lot of uncertainties at this point of the year, the first phase of this year, and we will see because we are at the beginning, isn't it? But in my last question, Timothy, I want to ask you about what do you expect about the different industries that can report growth the upcoming months? What do you expect which industries can be stronger in this year?
Right. So, you know, I track the top 6 very closely. It makes up 70% of manufacturing GDP. The chemical products area, as I mentioned, 14% of manufacturing GDP, was the first to go into contraction. And it's a foundational industry that supports pretty much the other 17. So not a really big surprise that it did that. So I mentioned the transportation sector would be something to watch here to see if the supply chain is going to be stressed again, which it isn't right now. The other one to watch would be the chemical products area. If we see the chemical products area get close to an expansion level again, that's a real positive indicator because they're going to be the first ones to see orders in the extended supply chain. You know, they're 4 to 6 tiers down in the bill of materials. They'll be the first to see it, and we'll see it pop up in the new order level. So, we talk about the recession. We've been in an inverted yield curve now since I think May of 2022. The people who watch this stuff have said that it takes 9 to 12 months for that to turn into a U.S. GDP recession. And our history kind of indicates on the manufacturing side that we're 6 to 9 months. We go into contraction, 6 to 9 months later, we see an issue with the overall U.S. economy. So we've only been in contraction now 2 months. You could argue that sometime at the end of Q1, Q2, we're going to see that. But, so much is weighing here on what the Federal Reserve is going to do with their next FOMC meeting, and are they going to continue to raise rates at a pretty aggressive rate? I think they've signaled that they're not, but it remains to be seen. We're very close to that. We're no longer accommodative, and I'm not so sure we're really restrictive. And the question is whether they want to put us in restriction. I think a lot of that has to do with layoffs and employment level and open jobs. The JOLTS report came out this morning, surprisingly high numbers. Our employment number came in higher than I thought it would be. But I think, let's see what January and February brings on the job side. I think we're going to see some pretty significant shifts there. And if you see manufacturers start to release employees and their suppliers release employees, you might start to see, some more positive signs here on the demand side, and maybe more new orders getting placed.
Timothy Fiore, it's been a pleasure as always. Thank you so much for this first interview of the year with you.
You bet. Thanks, Marta.
Nos quedamos, por tanto, con